Hello, John Price here, and I'm joined by Tim Serjeant and Dave Allingham, portfolio managers at Eley Griffiths Group. Today we're going to cover some ground on the portfolios. The mid-cap fund has had a very strong start. It's 1 year in, up over 26%, very strong in an absolute sense, but also relative versus the market. What we want to cover today is, Dave, let's start with, are we sticking with the portfolio that's been working well, or are we starting to make some changes around the edges?
No, great question, John. And look, I think you've got to go back in time and think about where we've been for the last year or two. The headlines were riddled with inflation fears, cost of capital fears, recession fears. You fast forward to today, we've clearly come out the other side. And the main thematic we think for the next 12 to 24 months, which is going to drive asset prices, is the fact that we're in a global synchronised easing cycle. Yep. So why are we in an easing cycle? Well, the Fed's just cut 50 basis points. But why are we there? And we believe the global economy is going through a moderate deceleration at the moment. It's no disaster, but it's clearly moderating as far as economic growth. Inflation's under control, employment's a little weaker. And so therefore we need to respond to that in the portfolio. So we have been making some changes. Some of the big winners of the last 12 months, the Pinnacles, the Brevilles, the GQG asset managers, those kind of positions we've been harvesting a little bit, and we've been rotating into what we see as the next opportunity, which doesn't say where, that next opportunity is more what we see as a more defensive earnings streams, generally speaking, that have less cyclicality to them at the moment. And it's not that we're necessarily bearish or anxious about the economic outlook, but we just see more opportunity in those sectors versus the sectors we've been in.
Tim, let's talk some names.
Yes.
Dave talked about the macro themes and why we're making changes. How's that actually translating to in actual names?
Yeah, so drilling down to the portfolios, I think to Dave's point, the breadth of opportunity in the market's changed, and so are we. So perhaps sectors that were perhaps impacted the most by rising rates and rising inflation. I think about the REIT space. Certainly pockets of the consumer discretionary market as well in the last 12 months. They're kind of names that we've been looking at coming from the buy side. So Charter Hall, the property funds management group, has been a stock we've bought with conviction in the last 3 or 4 months. Vicinity Group as well. It's a REIT itself. And then in the consumer space, we've identified a handful of names which we've seeded positions in and looking to build conviction in as we go into the half year results.
Yep. And let's just talk about, some events that are coming up or events that are in play at the moment. Let's talk about China, and then I'll ask you about the AGM season, Dave. So, Tim, China.
Yeah, look, really topical. And obviously, I think we've had this feeling for a while, the US election pending. As we stand today, the polls would indicate a Trump presidency and Republican sweep is the most likely outcome. But that being the case, I think Trump's a known commodity in the sense, and tariffs were a talking point in 2016, and they're clearly a talking point going forward. So we've anticipated some response from the powers that be in China, and we've sort of got the early signs of one, at least trying to put a floor under proceedings and increase consumer and business confidence there, which has been on the wane, as we know. So the policies that have been announced today look interesting, particularly around the equity market and what they're trying to do there. But I think as it stands for us as direct investable companies, from our perspective, it's clearly going to impact upon consumption favourably. So there's a couple of names there like A2 Milk, for instance, we have a holding in, we think is a beneficiary, but also the base metal names, I think which are more driven around consumption as opposed to the bulk material names, which are property and construction driven. We see the base metals as being a beneficiary, and it's probably less clear on the bulk commodity side.
Thanks, Tim. And so now AGMs. So what themes are going to come forward at the AGMs?
Well, typically October, November's AGM season. We're quite early in AGM season this year, but it's already clear to us that what we touched on before around being really in a moderating economic growth environment is that there's a little bit more earnings risk out there. So I think what you're playing for at the moment is avoiding earnings risk. I think, you're not necessarily playing for big earnings upside, you're just looking to avoid the potholes. And so I think what we've seen is, yes, Tim mentioned there's been some interesting updates from retailers, generally more positive than not. But in other sectors, we've seen clearly earnings downside risks that have been dealt with quite harshly in the market as well. So again, really, we have quite a large quality overlay in how we invest, and that's not just in the financial metrics. It's in the people, it's in the company strategy, it's in the long-term earnings profile of the companies, and I feel like that should look after us as we move through a lumpier and more volatile earnings season.
Yep. And so let's bring this all together. So we've got the easing cycle, we've got the themes coming out of AGM, we've got China events, we've got the presidential election. What's this mean for growth assets? What does this mean for this bull market?
Look, I think what we've noticed, John, I think from an equity standpoint, we're very constructive. A coordinated easing cycle that David talked about, which we seem to be on the cusp of and already underway in certain markets. We're just seeing the opportunity set broaden, and what we've seen really in the last month or two is it's gone down the market cap spectrum. So it's a lot more prominent in the small and emerging and micro end of the market, and they've been obviously, again, the style of companies that have been hurt most by high inflation and higher rates, and that transmission mechanism working its way through the market has seen the opportunity set perhaps there present as attractive as it has been for some time.
Well, thank you, Tim. Thank you, Dave, for your comments today. And if anyone has any follow-up questions, please reach out to myself.